G'day everyone, welcome back to Pete's Investing. Today is July 6, 2023. This is the New Zealand Canadian dollar currency update. On the weekly we're in a bearish mode. On the daily we're in a bullish, so it's undecided. There's a trend, so if you're trading the trend, probably avoid until we get a bearish signal on the daily at least for a downtrend. You can see there on the hourly it's starting to turn down, already in a bearish mode. But on the weekly, first off, we look at the triple moving average of the price chart, the CCI moving averages, and the oscillator showing a bearish signal, hence the bearish signal overall on the weekly trend, so only taking bearish trades as a trend direction trader. On the daily, however, we're still in a bullish mode with our oscillator here showing a upturn, but notice we've got a bullish divergence on the CCI versus a bearish divergence on the price chart. And I've drawn a channel here between that divergence range, the highs and lows. So the entry point will be once it breaks above that channel. And in terms of a target area, we draw a Fibonacci retracement to the upside. So once it breaks above that channel, our initial target area will be somewhere between the 50% level right up to about the 78%. Now it could possibly go higher, but we're going to put in, to be realistic and to be high probability of success, we're going to put in somewhere between the mid-range of that 50 to 61% Fibonacci range. But there's a good chance it may actually come up and hit this descending line if it's going to gravitate to that, possibly. But again, there's no guarantees with any of this. Now on the hourly, there's a different divergence happening, and these are independent from the daily. You can see there more closely. We've got a bullish divergence on the CCI versus a bearish divergence here on the price chart. You'll notice the price went up somewhat, but it fell from there. So we draw and we extend that to that area there. And we also extend that divergence on the CCI. So that would have been your first area to look at. And let's just draw. That's where you would have entered the trade when it broke above that channel there. And in terms of entering a target, we go to that recent Fibonacci high. So if you entered when it broke above the channel, your entry point would have been somewhere between the 50% right up to the 78% level to be a higher probability of success. So somewhere around the 61% ideally would have been your ideal exit. But you can see here it's gone way beyond that, and in fact it's gone as high as almost the 161% extension on that Fibonacci. So that's that one. We've also got another. Just delete some of these, clean it up. We've also got another bearish divergence you can see there on the CCI versus bullish on the price chart. Now you'll notice we've drawn this already, but it's actually the price has continued to the upside, and so has the CCI. So now there is no divergence. The CCI is increasing, and so is the price. So we delete that, and it invalidates it, because had you drawn that, you wouldn't have entered that trade because it didn't fall below had you gone back to this point there. Just trying to show you the logic in doing all this. If you had tried to trade that, your entry point would have been when it broke below that channel. That's where you would have had an entry point. But you'll notice that the highs and lows of that divergence range, it didn't actually breach that lower channel, so you would not have entered the trade. So no harm done. So what we do now is we delete that because there is no divergence on that timeline. But you'll notice what we have now is, you can see there from there to there, we have a bearish divergence on the CCI, and we have a bullish divergence on the price chart. So what we do now is we draw a new target area, and that'll be in that divergence range. That's the lowest candle. So we look at potentially breaking it, and you would possibly enter it right now as we speak. There's an entry point there. So that'll be our entry. We'll place an entry there. And in terms of targeting a Fibonacci range, let's pick from this recent low to that high. So our initial target range will be between the 23% level down to about the 38% level. So that's our initial target range, and we'll see where we go from there. You can see there it's punched through the lower channel, and that's our entry point. So we'll keep an eye on that. So watch that divergence. As well, in terms of trading the trend, which is a different strategy altogether, we've got these back tests. You can see here, while the price was declining, this is the short back test. You would have entered that strategy going short using the oscillator, which we showed you from our weekly and daily, and that's the oscillator we've demonstrated, and we demonstrated that in a previous video. So that's the strategy we use on the hourly time frame. So this is demonstrating using that strategy going short, and this is and when it goes long, you can see there when the price starts moving in your favor, that's where you enter those trades. So to avoid entering long trades during this downfall, you only trade in the direction of as I said, we only trade in the direction of the weekly and daily when they're aligned. And so if they're both going short, that's when you enter the trades going short during that period. When the weekly and daily are going long, you enter the long trades going long this way. So that's just the strategy on the oscillator, as well as the different strategy on the divergence to be looked at. So anyway, to understand how to trade this and other trading strategies, subscribe to my Patreon page, where we also do weekly scans of stocks, currencies and commodities. Subscribe, like and share the channel. Thanks for watching, and see you in a future video.